Well, good afternoon, everybody. I'm Ric Edelman. Thanks so much for joining us for this very important webinar. You know, we've all been excited about the fact and certainly very interested in the fact that the SEC has given approval to the new spot Bitcoin ETFs. And it has raised a fundamental question among financial advisors and investors alike. How do you figure out what products I ought to be using and investing in, adding to my portfolio or to my clients' portfolios? That's what we're going to tackle here today. How to engage in due diligence of asset managers, products, and platforms in the digital asset space. And to help us engage in this conversation, I'm very happy to be joined by two leading experts in this field, AJ Nary, who is the head of HeightZero at BitGo, and Matt Kolesky, who is the co-founder and COO for Arbor Digital. So gentlemen, join me here if you would. And I'm looking forward to having this conversation. It's great to be with both of you.
Great to be here too with you, Ric. And AJ.
It's great to be here, Ric. Thank you.
So Matt has been in this field for about as long as Bitcoin has been around. He is not only president and CCO for Arbor Capital, been an RIA for decades, and began mining Bitcoin way back in 2009, which was when Bitcoin was first invented. So Matt, you've got a long history in this asset class. Tell us though about BitGo, which I don't think is a household name among many advisors.
Oh, AJ's with BitGo, but yes, I'll let him speak to that.
Oh, yeah. So I'm sorry, Matt. I'm referring to, of course, to Arbor Capital. So
yeah.
Tell us about Arbor.
Yeah, and I started mining back in 2011. I'm not sure 2009 got put in, but anyway, yeah. Arbor Capital is the parent company of Arbor Digital, which is a full-service SMA that manages digital asset portfolios for clients around the country. And so we launched back in 2020 after starting this journey with digital assets for our own clients back in 2018. Ric, you mentioned, yeah, I've been an advisor, for over 20 years, and really have been looking for the best way to get access for clients to the underlying prices of these assets. And so that's what precipitated us to launch Arbor Digital and offer our services not just to one IRA but to the entire country.
What I find really interesting is that you not only do a lot of asset management yourselves, but you do a lot of crypto consulting for others. And we're going to talk about that in the conversation today with AJ. And there we go, AJ. I've gotten myself all backwards. AJ, the head, of course, of HeightZero at BitGo, who's been in the crypto space for a decade as well. AJ, I want you to tell everybody, because as I begun to mention earlier, BitGo is not really the household name, even though you're really a rather large organization.
Absolutely. Thanks, Ric. So HeightZero is a platform, technology platform that allows financial advisors, broker dealers, and RIAs the ability to invest in digital assets. HeightZero was acquired by BitGo in October of last year. So that's why it's HeightZero by BitGo. BitGo is the second largest US institutional custodian, right behind Coinbase. And we are the custodian for two of the ETFs, the spot ETFs that just came out. We'll be the sub-custodian for a few others here in the next few weeks. And so honestly, custody is what we do and what BitGo's done for over 10 years now. And we're really trusted by a lot of institutions to be able to store their assets securely.
And now you can get a sense as to why we really wanted to do this event with AJ and with Matt, because it's not just about these spot Bitcoin ETFs. There are so many other digital asset products that are available that have been around for years. And many advisors are largely unfamiliar with a lot of these and just getting their feet wet with the new ETFs that are existing. But I think we're going to quickly discover that these ETFs are really the entree into crypto, perhaps, for a lot of people, but you're not going to stop there. So we've got an awful lot to talk about. And as we get into this conversation, I want to include you as well. So keep in mind that you have the opportunity to ask questions. Many of you already have. When you registered for this event, you sent us a question or two. We will tackle as many of those during this conversation as we can. And if the dialogue you're about to hear triggers any questions in your mind, just go to the Q&A box here on Zoom. I'll be monitoring those as we go and weaving in those questions as well as we engage. But I want to begin the first question, Matt, to you. There is a renewed level of attention and focus on crypto because of the launch of the new spot Bitcoin ETFs, which are now about a month old as we do this conversation. Billions of dollars in assets already, the most successful ETF launch in history. But these ETFs are simply the latest product that exists. And let's face it, they're just Bitcoin. They don't give you access to any other asset class that exists in the crypto space. So another really popular product that advisors love to use are TAMPs, for example. And there are digital asset crypto TAMPs that are available, as well as other crypto funds. So why not? So which way should people go? Should we focus instead just on these new ETFs, Matt, or should we pay equal attention to the TAMPs and other crypto funds that also are available?
Yeah, Rick, and you hit it on the head. Yes, it's a good entrance for a lot of people that have been sitting maybe on the sideline waiting for this approval. But as you pointed out, right, it's just one asset in this very quickly growing digital asset ecosystem. And so one of the ways that I like to think about this is if you're contemplating investing in these assets, take a step back and think about what is the best thing for your firm and for your clients, right? As a fiduciary, and many of you are, even if you're not, you're thinking you have to put what's the best interest for your clients here? And you have to be thinking about that. Is it just a one asset, one product fund? It might be. But if you're looking to potentially go farther down into the digital asset class, you might want to be thinking about how to go beyond just Bitcoin. Maybe there's Ethereum, maybe there's other assets that you could be contemplating for your clients' portfolios. And AJ mentioned this earlier, right? The really important word for advisors and for other financial professionals is custody. What does that look like? So when you're thinking about the best way to approach this for your clients, you have to work with trusted custodial and exchange partners. And so that's a lot of the work that we've done, and I'm sure AJ will talk about this as well, but setting that foundation, because this is very different, right? These assets, they're bearer instruments, so if somebody gets a hold of them, they own them, which is very different from the traditional world. So getting into the ideas around custody, and what does that mean? How do you do the due diligence on a BitGo or a Gemini or a Coinbase for that matter? And advisors, right, we have an obligation to our clients to make sure that we're seeking out qualified custody and looking at things like best execution. And that's what we're here to kind of shed some light on for you today.
And really that leads into the next logical question. If you are going to do this work, how do you do the due diligence? We all know how to do due diligence. That's a big part of our careers, is figuring out what investments to recommend to clients and how to research them and evaluate them and analyze them. But are there, AJ, any due diligence issues when you're playing with crypto that you don't encounter with other asset classes or other TAMPs?
Absolutely. I think that I'll sort of use the ETF example as well. But as a custodian, it's not the same as an ETF in equities, where you'll have a custodian of State Street or Northern Trust, and you can leave all your assets there. One of the issuers actually posted their wallet online, and we really applaud the transparency there. It was a unique and very interesting decision. But part of the problem was, as people then started to analyze the wallet, which was single signature, which means there's one point of failure. Whereas BitGo is a multiple signature wallet. So there have to be multiple points of failure. So it's very important that we now start to create best practices in both the ETF as well as any other sort of strategy or SMA product that is coming to market. And I think we're seeing that evolve very quickly, because everyone's trying to do better, and these products are so new. That really we're coming to a best practices a lot sooner. And I think what you're going to see in the future is, although BitGo already does custody some of the ETFs, I think that every ETF will have multiple custodians. just to diversify away that risk. And that's only one risk that we talk about when we're thinking due diligence. BitGo as a custodian, we handle the custodian risk. There's always trading risk and other things that also you should be looking at when you're deciding to invest in the asset class.
Yeah, I think you're raising an important point, because when we're all used to buying stocks and bonds and ETFs and mutual funds, and as investors, we don't really give a whole lot of thought as to where we're buying them. Whether you have an account at, I don't know, Schwab or Fidelity or Merrill Lynch or E-Trade or Robinhood, none of us really pay a lot of attention to who the custodian is, because let's face it, if I'm going to buy shares of IBM, it doesn't really matter where I buy it. I mean, it's IBM after all. And even if something did go wrong when my brokerage firm were to collapse, I've got SIPC to back me up. And I've got the brokerage firm with gazillions of dollars of assets and insurance and all kinds of things, and 75-year or 100-year history. And I don't really have to worry so much about where I buy my shares of IBM. Something goes wrong, somebody will send me replacement shares of IBM. It's not a big deal. But crypto is a totally different beast. It's a digital asset. There is no paper anywhere. And so we've got to pay attention to who that custodian is, because the custodian is playing a much more important role by the very nature that this is a digital asset as opposed to a physical one. And so I think many advisors are out of practice when it comes to evaluating custodians, because we haven't had to do it in probably our entire careers. It's just been a given. In fact, I don't even think many advisors have stopped to think that there is a custodian involved when you open a Schwab account. So when you're dealing with this, I think people are trying to figure out, how do you evaluate the custodian? And I'm giving you a leading question, because there's a document that you guys have created that I'll just show here really quickly, the Custodian Evaluation Guide. We are putting this into the chat box, a link to it, and a bunch of other documents that are incredibly helpful. Very simple. It's just a few pages, but it really has a lot of detail that that I thought, AJ, you would want to elaborate on. Talk about this Custodian Evaluation Guide, because I think it's about as basic as it gets in your due diligence.
Absolutely. And I think that's the perfect place to start. In the past 2 years, I think we've had not the opportunity, but not even the luxury, I'm trying to think of the appropriate word. We've had a few issues with exchanges, whether that's filing for bankruptcy or fraud. And so there's been a consolidation in the custodian market and in the exchange market. And so I think that the first thing is looking at the qualified custody. If you own a security, and leave the security question aside, I'm not going to touch that. But if you own a security, you need to hold it as an RIA with a qualified custodian. But unfortunately, the SEC won't just come over and say, hand stamped, you're now a qualified custodian. There are rules that you need to follow and be able to represent yourself, so as a qualified custodian. So at BitGo, we've done that with the regulators, said this is why we think we hold this. And there's really only a few of them that are in the market now that hold themselves out as qualified custody. There were some technology platforms a little while ago that would talk about it, but then it would be more of a self cold storage wallet, and that gets very dicey with RIAs in terms of who actually has custody assets. And so
let's elaborate on that, AJ, about wallets. Give us a quick definition of hot versus cold.
Sure. So a hot is connected to the internet. A cold storage wallet is not. So when you trade, in theory, the cold storage wallet, there needs to be multiple physical people walk in and get those assets out of our vaults. Now, you can trade instantly, so it's not like you have to wait 2 hours for someone to do that on our platform. But come settlement time, there is that actual physical people moving from point A to point B with those cold storage wallets. And cold storage makes it much less likely that anything gets hacked, assets get lost, and each individual wallet has 250 million in insurance. So we were talking about best practices earlier. We keep our wallets under 250 million, so that if one wallet does get compromised, which has never happened in the 10 years BitGo has been in business, but if it did, you would be insured for that. And actually having multiple wallets compromised is basically impossible. So that's how we're trying to go ahead and sort of be the best standard for that kind of due diligence.
So, Matt, while AJ has articulated pretty effectively the importance of wallets and the way that they're treated by different custodians, due diligence goes a lot beyond just that element of it. You've created a due diligence form that's 16 or so pages, and we're going to drop this into the chat box as well. This is one hell of a document that is very thorough and comprehensive into what it is that advisors need to be looking at when evaluating crypto managers. Talk to us about the exercise of going through due diligence and using this as a guidepost through the exercise.
So he was talking about evaluating custodians. And so when you start to look around asset managers and how to evaluate them, right? Custody is a big piece of that, because at the end of the day, the assets need to live somewhere. And as AJ was describing, all the security measures in place that BitGo has, and we have other qualified custodians that are out there. But that's really kind of the launching off point, and getting comfortable with these assets. And that's what this document starts to help people get familiar with what they should be asking, not just from the custodian standpoint, but from an advisor, from an SMA and a product standpoint. So this document helps people on that journey to say, okay, this is the work that they've been doing. This is the work that's been done. Because it is a little bit different, right? The traditional, you talk about like stocks and bonds, great. Yeah, Schwab, Vanguard, Fidelity, whoever, Merrill Lynch, it matters, but it doesn't really matter at the end of the day. These assets and how the organizations that are handling them, it has to be examined thoroughly. So when we started this process, Rick, I had to go down and learn a lot about what does qualified custody mean from that aspect for a digital asset, taking literal guidance that really didn't, from 30 years ago, and trying to apply it to digital assets. And so this document kind of represents a lot of the work that we've done throughout the years. And so one of the things that I became familiar with, right, SOC 2, type 1 and 2, we had to evaluate that, right? That's a really important internal control document for some of these custodians to be able to demonstrate, say, yes, we have these internal controls in place. And that's really important for us and for maybe potentially you to say, yes, I can hold these custodians out as a qualified custodian for my clients as a fiduciary.
Now SOC 1 and 2, that is more general. That's not a crypto thing. That's a fundamental asset management thing. So elaborate on that. Many advisors may not be familiar with this.
Yeah, so it's important to understand for the SOC 1 and 2 is demonstrating internal controls. And why is that so important in this instance? Because if you get hold of these assets, they're bearer instruments. And so if there is a breach, anybody can control the assets. So SOC 2, type 1 and 2 are really important for crypto to demonstrate proper internal controls around wallet and custody, and is mostly around the hot wallets and the cold wallets. So that's what it's there for, to protect.
So is there anything in particular that you have found through the many occasions where you have engaged in due diligence efforts of crypto investment managers? Are there ever any commonalities or things you see over and over again where that makes it difficult to do your job of evaluating these managers? Any hurdles advisors can expect to encounter in their effort to do due diligence on crypto managers?
I haven't seen too many. I mean, there's a few red flags I would say that are out there. One of the things is, kind of the Lindy effect, right? It's in this document. We've been here. We're going to be here for a long time. AJ alluded to this. We've seen not just TAMPs go away, but we've seen asset managers come and go. And so part of the process, right, is understanding what is the ethos of the manager. We're in this for the long term. We're going to be here. We're passionate about digital assets. We're not just jumping in the last year or two, or, and trying to capture some market share that way. So it's really important to understand that. And that's, to me, a little bit of a red flag, is if it's somebody just coming into the industry brand new because they're being asked by their clients to do so. And, it's like, so that's why we exist, for people that can bring us forward to help them manage their clients' digital assets.
Matt, I'd really like to echo that, because
Yeah,
it's been a lean 2 years.
Yes.
Basically in October, things started going better, and it's been a nice few months. But, I have seen in my previous experiences as well as this, where, it's a hot trend now, I'm going to start a digital asset arm. Then I'm going to close a digital asset arm. Oh, it's back in vogue, I'm going to
Yep.
start another one. And that happened in ETF trading desks, 10 years ago, and it's happening now. So I can't echo that enough. Of when we look at managers, and that's certainly why we partner with Matt, because we've known him for a long time. And in the lean years is when you know who your friends are and who's in it for the long haul. And I think we've just sort of come out of that time period right now.
This asset class.
And along those lines, AJ,
go ahead.
Matt, please go ahead.
Oh, yeah, I was just going to, we've seen, not just advisors come and go, but TAMPs, other even custodians that AJ talked about, right? That's why this due diligence, Rick, is so important. You have to get it right, right? We've seen, people running Super Bowl ads a couple of years ago and everybody FOMOing into things. That is not what this industry needs. And that is not what we're here to talk about, right? This is about doing it the right way, with qualified custody, with financial professionals that are in this for the long term. And Rick, you talked, the designation, the one that you created, right? That's really important for showing genuine interest of like, how can I, as a financial professional, educate myself more, listening to this webinar, getting certified, getting the DACFP certification, going out, getting the CDAA from Planner Dow. Those are really important for financial professionals. And if you don't have those designations and the people you're evaluating don't, that is a big red flag.
And so that's where I was going to go with this, about your comment about the TAMPs, and I'm a little concerned, AJ and Matt, you both have said this, that some of these companies are fair with their friends. They view crypto as an asset grab. It's just an opportunity to collect AUM because they know they can sell the product, and they're not really believers in this space, or they're not really experienced in the space. And you have to wonder in the C-suite, how committed are they to engagement here? Is that problem a particularly crypto problem? I'm just wondering if we haven't also seen that, say, in the ESG world or in other areas of asset management, where it's a common thread, isn't it? Where an asset manager says, "Yeah, we can collect some AUM. Let's launch a Me Too fund, and do like everybody else is doing." I didn't mean Me Too that way. I meant it this way. So you know what I mean. So is this a unique crypto thing, or does this happen pretty commonly in the world of asset management?
I mean, I think that's a great point. I don't think it's a crypto native thing. I think that there's always those issues out there. I think that the difference is when things go poorly from a ESG strategy, or I launched this ETF and I got no funds in it, they just shut it down. If you don't know what you're doing in crypto, there is a magnitude of bad things that can happen to your clients, and we've already seen them. And so I think it's definitely not just a crypto issue, but because of that magnified risk, it's more important to be looking at that sort of transparency and actually understanding exactly what is happening when you're investing. And I always, oh, sorry, go ahead.
No, finish the thought.
I was just saying, I always like I always sort of preach, like, do what you are good at, right? BitGo does not create strategies. We do not sell products to people for investing. We do custody. We don't have a hedge fund. We're not an exchange. We are a custodian. Things get very concerning when you've got the same custodian, trading partner, hedge fund, anything. When you start commingling those things, we've seen it. It really gets concerning, and that's why, like you were talking about Schwab earlier, where Schwab will execute on the exchanges. They're not running their own prop book in-house and trading against their own flow. So like, right. It's very important to sort of adopt some of those.
Yeah, what you're describing, of course, was FTX. Playing every role in the game, and look at the disaster that occurred compared to way a responsible company like Schwab would manage it. But that raises the question in my mind that let's say that I wanted to buy an S&P 500 index fund. That's about as plain vanilla a product as exists in the market. And everybody's got one. If you're an asset manager, chances are really good you offer an S&P 500 index fund. It doesn't really matter a hell of a lot where I get it from, other than the fees and expenses, perhaps. There might be a couple of other nuances making one a little bit different from another, but at the end of the day, they're all going to be really, really similar in outcome for the client. And I think they're all really, really similar in terms of safety for the client, in terms of this thing blowing up, disappearing, fraud and abuse, that kind of thing. I can't remember ever a fraud story about an S&P 500 index fund. But are you saying that that doesn't necessarily exist in the world of crypto, that you could find a player in crypto today where a really bad outcome is possible?
Yeah, I mean, I think I'll sort of push that to Matt, because that's more of the due diligence of the managers, right? When we work on our infrastructure, I know Matt takes to spend a lot of time understanding even the infrastructure of those assets and the custodian versus best X and all that stuff. So Matt, why don't you opine, which I know you can, on that?
Yeah, so I'm pretty passionate about this. And when you take the kind of index analogy and apply it to digital assets, that's where I start to kind of differentiate. I think this asset classes, these digital assets, move so quickly, and there's airdrops, there's forks, there's all kinds of things that can happen. And if you have a top 10 or a top 20, there's assets that can climb into there that I don't want to own, that frankly most people shouldn't own, and they might not even need to be a token, right? And so one of the things that we look at is, how do we evaluate these projects and these protocols? And really, at the end of the day, it's technology. And we start by asking ourselves, when we're evaluating these assets, is, does it even need to be a token, right? And I think we've seen a lot of that. We've already talked about it, but FTX, they don't need a token. Like, there's things that are out there that don't even necessarily need to be a token. And so one of the things we've learned in the last few years is, one, you have to keep an open mindset and evolve. And so you need to be able to understand, what is the value add for these? Not just the TAMP and obviously the custody side of it, but from the underlying assets themselves. And I mean, we could spend an hour and a half talking about Bitcoin and Ethereum and their value add, right? But when we go beyond those is really when we start to get into the underlying infrastructure of the networks themselves and these assets of what they're trying to do. And yes, there are bad actors. There's bad actors at every level, unfortunately. That's part of the due diligence process that we come into play, from the custodial all the way down to the underlying investments. And it's really important to have trusted partners that understand this asset class. One of the
areas that I think is going to get a huge new level of attention by advisors are these crypto TAMPs. And I think it's the ETFs that are going to drive this. For most advisors, we know that only 12% of advisors, according to the latest industry surveys, only 12% of advisors have been recommending Bitcoin to clients. 77% of advisors have said they're waiting for the ETFs to become available. Now that the ETFs are here, we are going to see massive numbers of advisors enter the crypto arena for the very first time with client portfolios. This evolution is going to occur over the next year or so. It's not a light switch. It's going to take time for advisors to engage. We've got to do the focus of today's conversation. We've got to do our due diligence. We got to figure out which of these ETFs to recommend. And we got to figure out which clients to recommend them to. We got to figure out what the allocation ought to be. Then we've got to explain all this to the clients, and then we got to execute the trades. It's going to take months for the flows to come. We've already seen pretty big flows, but it ain't nothing yet. I'm on record of predicting that we're going to see $150 billion worth of flows just from the independent RIA channel over the next 2 years. So it's going to be big. But I don't think it's going to end there. I think what's going to happen, and this is a premise, I want the two of you to tell me if you agree or disagree with me here. I think that what a lot of advisors are going to experience is that these Bitcoin ETFs are the beginning. They're going to take the attitude after they've done it, after they've added this to client portfolios, they're then going to realize that all they really did was give their clients Bitcoin. They didn't give them Ethereum. They didn't give them Algorand or Polygon or Filecoin or Chainlink or any of the other major coins that exist, Avalanche, the list goes on and on. And they're going to realize that by giving their clients a single asset ETF, they didn't provide diversification, which is a huge mantra for financial advisors. We love diversification, and we're not really offering that with a single asset ETF like Bitcoin. So I think this is going to lead a lot of advisors to looking for what's next, what's better, what's different. How can I more effectively allocate to crypto on behalf of my client that isn't a single asset product? And I think that's going to lead them to crypto TAMPs. Where they can custom design a highly diversified crypto portfolio. They can manage the rebalancing and the tax loss harvesting for each individual client. And they can create the level of customization that you simply can't do in an ETF wrapper. And for that reason, I think these crypto TAMPs are going to get a lot of attention. So I have two questions for the two of you. First, do you agree with my premise? And if you do, then I've got my second question for you. Matt, you go first.
I do agree, Rick. I had a bittersweet, moment when the Bitcoin, they were approved, because I agree it's a good first step, and it provides more eyeballs and more visibility for now people, for advisors and financial professionals to have the confidence to say, okay, the SEC finally did come in and approve these products. So yes, I do share your vision there for the path forward for advisors.
I'd like to make one correction, if I could, to your statement. You said that you then had the financial advisor give their client Bitcoin. They didn't actually do that. They got exposure to the asset of Bitcoin. I think that isn't, I mean, like I said,
Yeah.
I am not an end of the world guy. Don't get me wrong, I have a go bag, but like it's, with banks failing and all these different things, those digital, or those TAMPs, those digital asset TAMPs, your client owns the physical. If our client would like their Bitcoin, now there are lots of checks and balances because we don't just start sending out digital assets left and right. But if they wanted to get their actual physical asset, I can send it to a hot wallet, a cold hardware wallet. They have their own. I would like to just differentiate that because I completely agree with you, but I want to make that distinction.
Yeah, thank you. I was using sloppy colloquial language and not precise, as you pointed out. So you're absolutely right about that, AJ. So if you're both in agreement with me philosophically or theoretically that the Bitcoin ETFs are going to be the entree to the rabbit hole, but the advisors are not going to stop there, and they're going to realize over time that TAMPs offer a really interesting way to be of greater value to the client, it raises the question about doing due diligence with the TAMPs. So AJ, are there factors in choosing a crypto TAMP that you don't normally encounter with ordinary TAMPs that you typically find in the stock and bond markets?
So we've definitely modeled our product off of the things that RAs are comfortable with. So those traditional equity TAMPs. So if you come to our platform at BitGo, you can rebalance, you can do tax loss harvesting, you can do the reporting that you need, you can do billing. So I would say, sort of getting back to our previous discussion, the most important things from those TAMPs is the reporting and the connectivity to your existing tech stack, which is very important because clients, are the reason I started the company 5 years ago was that I had clients come to me and say, they are asking us, we have no solution. And then they are sending out billable assets, which that sort of held away asset model doesn't necessarily really work. And so I think if you're looking at it from the difference between the two, it's really that custody trading side where that infrastructure is still being developed. But Matt uses our platform, so I think he'd also be able to have good feedback on that question.
Yeah, one of the things that is consistent with this industry, digital asset investing, is it's a relationship business, right? We've known AJ for a long time. We followed the path of his firm that is now under BitGo, and we're very comfortable with them, obviously comfortable with BitGo. And so we know what HeightZero's technology is, and we are multi-custodial and multi-platform as well. So we use AJ's product for our clients. And so, Rick, to answer your question, there's nuances to understanding how the digital asset technology platforms, the TAMPs, plug into the back end of the custodians. How does that architecture work? How is the wallet, the ultimately, the client's segregated sub account and wallet separated and accounted for in the technology overlay? And so there's a lot there that we can unpack, but that's really where we focus a lot of our due diligence on the TAMP itself. And I just want to reiterate, I love what AJ said, right? It's like, yes, if you own a gold ETF, you can't really get your gold. If you own a Bitcoin ETF, you're not going to get your Bitcoin. If you own Bitcoin through one of our platforms, we can have the custodian send it to you. You can take physical custody of it yourself if you want to.
So that raises a really interesting thought. I don't think most advisors would really have given any acknowledgement to, of recognizing that distinction. I'm assuming, therefore, that if you have a client that you discover currently owns Bitcoin, because this is something I encourage advisors to do all the time, ask your clients, do you own crypto? We know that 20% of US adults do. 52 million Americans own Bitcoin. They've almost all bought it on their own because they couldn't get it through an advisor. And if 20% of overall adults own Bitcoin, let's face it, most of them are more affluent, because you got to be affluent to be able to afford to buy assets. That means chances are it's a bigger percentage of advisor clients. I think it might be 30 or 40% of clients of advisors who have some exposure of some kind to crypto. And I don't think most advisors know this. In the surveys we do, less than half of advisors have ever asked their clients, do you own crypto? So start there. Ask your clients, do you own this? And if they do, chances are it's Bitcoin, the number one choice of everybody who buys crypto. If you own Bitcoin or Ethereum, what have you, the advisor can say to the client, well, you can transfer your Bitcoin to me. You don't have to sell it. You don't have to incur the capital gain tax. You don't have to pay fees. You can transfer your Bitcoin from wherever it is at the moment to me via this TAMP, and I can now take over the management of it for you, just like I manage all of your other assets. You're relieving the client of the chore of the rebalancing and the dollar cost averaging, the tax loss harvesting, the record keeping and tax reporting. You can integrate it with the rest of the portfolio. This is why clients hire advisors all the time, to eliminate those chores. And the advisor gets new AUM. So it's a win-win. Everybody's happy. But what I find is that the advisor couldn't say that about the Bitcoin ETF, to your point. The ETFs can't accept Bitcoin. They can only accept cash. But the TAMP doesn't have that limitation, right? That seems to be a pretty big deal for advisors who want to help their clients who already own Bitcoin.
That's great. And honestly, I kind of never thought about it that way, because I've been out of the advisor game for so long. But I mean, I have an advisor myself, and he talks about, he's like, one of his clients was like, hey, by the way, just an offhanded comment, I have $100,000 in Bitcoin. He's like, wait a second, hang on, because like, you're a financial advisor, you're trying to give a holistic picture of that family, or whoever that person is. You take in the fixed income assets and all this stuff, and you're right, crypto's sort of been this almost like shadow asset off book that like people don't really talk about. But it is possible that if you had that, the advisor has a good idea of getting a much better idea of your overall financial picture. But yes, that's been recently, we've had a lot of advisors accept Bitcoin from various places, like you said, mostly retail exchanges, into their book of business, maybe rebalancing a little bit, or if the client wants to hold it and kind of let it ride for a little bit, maybe they're overexposed a little bit, but they have that conversation with the client and document it and say, listen, we wouldn't advise this, but it's yours. And it really makes the advisor's life a lot easier, and sort of uncovers possible new money, but also just sort of a huge differentiator in that client's portfolio.
I'm glad you mentioned that. Yeah, because we've had a lot of clients, and some of our advisory clients as well, start managing their clients' digital assets because they just asked the question, and then they brought the scenario you described. Yeah, maybe they were holding them somewhere or had them on their own wallet, and they moved them in, and then we were able to diversify them out of one or two just assets into a more holistic digital asset portfolio.
Yeah, one big issue that we tend to forget is that the people who went to the trouble of buying Bitcoin when Bitcoin was inconvenient, and let's face it, for much of the last 10 years, it has been inconvenient. It hasn't been a seamless, easy way to buy it, the way you can buy shares of IBM. So anybody who went to that trouble in 2015 or 2017 or 2020 or 2021, they're in the black. They've made money on their crypto. They may have made a lot of money on their crypto. If they bought it when Bitcoin was 3,000 or 13,000, or last summer 16,000, or more recently 20 or 25, Bitcoin, just hit 50,000. They've all got big capital gains. They also have a bigger allocation as a total portion of their portfolio than they may have originally intended. They may have intended to buy 1 or 2%, But because this has grown faster than other asset classes, they may now own 5 or 10 or 20% of the allocation in their portfolio, which means they really need to look at the rebalancing potential here, which I don't think most clients are paying much attention to at all, but which financial advisors can do for them. And knowing that there's a way you can seamlessly, easily transfer the existing crypto holding into a TAMP where the advisor can do the rebal, I think that's a huge value opportunity for advisors to demonstrate service to the client.
And we
Do you
have
find
a lot
clients
of,
and
go ahead.
No, go ahead, Matt.
Oh, I was gonna say, yeah, we help advisors answer that question of how much and when to rebalance, and we developed our own questionnaire that we share with our clients to ask their clients, right? How much do you have in digital assets? What is your threshold? What's your comfort level with owning these? So we've incorporated risk metrics for digital assets into kind of some of the industry standard risk tolerance questionnaires to answer those exact questions and then help people evaluate it, because you're exactly right. Yeah, if they bought it at 10 or 15, now it's at 50, it might be more than they're comfortable holding, and we can help them diversify away either out of just one asset into other digital assets or even back into traditional assets.
So let's talk about that. Let's go back up into the 50,000 foot range and talk about overall risk management. What is Arbor Digital's approach, Matt, to the big risk management question? How do you help advisors figure all that out when it comes to investing in digital assets?
So yeah, backing up, yeah, that's the view I like to take, Rick, is you have to decide if this is appropriate for you and for your company as an advisor or financial professional. Do you want to engage in this asset class? And Rick, you've been talking about this for years, right? 1%, you should be at least asking the question. And so from there, we can help folks think about what's the best way to incorporate this into their into their practice and their daily workflows of meeting with advisors, and how to incorporate these questions in. And so from that aspect, we view this from a risk perspective as, VC early stage investing. It's super speculative, it's super risky, not just for the reasons we talked about from custody and things like that, but just the price action alone is incredible, and it can move dramatically in just a short window, far more so than the traditional markets. And so we help advisors think through how to approach this through that lens of with their own clients, because for a lot of them, it's the first time they're offering this type of an investment for them.
Yeah, I
we've
think
got a bunch of questions. Oh, go ahead.
No,
AJ.
I was just gonna say, if we're gonna stay at that 50,000 foot level, and like I said, I started my career in financial services and asset management, specifically one of the first ETF strategists. So that global macro model with ETFs as exposure is something I'm familiar with, and as I've gotten older and been in the industry, I've found that the correlation, although it changes all the time, has kind of gone to one. And portfolio management, I think, is sort of a little, I don't know if it's easier now, but it's all assets in general will kind of go to a beta of one, and so, or a correlation with each other of one. And so the idea that Bitcoin or these other assets could be zero correlated, and have been in a little bit, I just think is very exciting. You've got negatively correlated assets, you got positively correlated assets, but a zero correlated asset that you kind of don't exactly know where it's going to go based on the market, and have it be really independent, is something that I think adds value to an overall portfolio in a small slice. Like Matt was saying, it's more of like that sort of VC private equity piece that should not be 80% of your portfolio, but it can be 1 to 2 to 3 to 5%.
We have a bunch of questions from folks. Let me try to tackle some of these. The first one, I think, is about as fundamental as it gets. Jeffrey has written and said that he said, I work for a firm that does not offer any Bitcoin or digital assets on any of our platforms. How do you recommend how do you recommend that I talk to my clients about investing in crypto without running afoul of my firm's limitations? He notes that he's a CFP and he's a fiduciary, and he wants to direct clients to crypto, but he doesn't have the ability in-house. Do you encounter that a lot with firms that are basically a blockade to their advisors and their efforts to engage in this?
We encounter that every day, Rick, and I'm sure you do too. So people have been asking this question for a number of years, and the only advice I have is, talk to the compliance department, get them to engage with, DACFP, get them to engage with this and help them understand that it's not just, some crazy speculative investment. It is actually a new asset class that's being built, and they're doing a disservice by not allowing you to invest in that. And so for your clients, if it's appropriate, so having your compliance folks and the people that make these decisions understand what this is and how it can help them grow, I think is a great way to start.
And I think financial advisors are between a rock and a hard place, because like, you're always trying to do what's best for your client, and you have that fiduciary responsibility. But could you imagine being a financial advisor and saying, hey, 2 years ago, we don't do it here, but you can go open up an FTX account. Like, not that the right, just because they saw it on TV, so not that the advisor was recommending or doing anything like that. It's just like, we don't do it here. That's a retail platform. Go. Like, that advisor could definitely be open up to exposure, like of just say, hey, you gave me bad investment advice because that company went bankrupt. And so I think that, that's why Matt and I have taken such like a conservative approach, but also like really understanding how to keep the advisors safe, because it just can be difficult. And even if people are trying to do the best thing by their clients, it sometimes doesn't work.
This is something you're passionate about, right? You're helping advisors around the country answer some of these questions and working with compliance departments and other decision makers at companies to allow more people more financial professionals to access this asset class. Lost audio for a second.
Yeah, I think we lost Ric's audio. I can take one until Ric comes back, because I saw that I saw one that said, wouldn't a risk managed Bitcoin SMA be better strategy for investors? No commingled assets, lower volatility. That's very interesting. It depends on what you mean by risk managed. If you mean derivatives, sort of like an options overlay or something like that to reduce the downside risk, that is very cool. I would say the problem with that is that that infrastructure hasn't been built yet, right? Like, we do spot, we don't do derivatives because the regulatory gets very tricky, and most people now in that SMA product would need to have a lot of that spot to do a strategy like that. So that's a multifamily office, or other really ultra high net worth or high net worth individuals. And so that, hopefully that's coming, and I think that you're going to see this with the ETFs. Now I'm at ETF Exchange right now, and the next iteration of the Bitcoin ETF is going to be, whether it's a factor-based investing for momentum strategy, or some type of derivatives overlay so they could do that. I think that that's something that is coming down, but not necessarily in our ecosystem.
I apologize, gents, for my audio dying on me there, but I think I'm back.
You're back.
Let me mention in response to Jeffrey was frustrated that his firm isn't allowing him to recommend crypto to clients. We have three answers that we give to advisors. Number one, you must remain compliant. Whether you like it or not, whether you're happy about it or not, you must stay within the rules and policies and procedures that your firm establishes. Do not play games. Do not try to be better or smarter than them or more creative. Don't run off the reservation. You have an obligation to follow the rules established by your firm. Second, try to persuade your firm to engage. And I think the new spot Bitcoin ETFs make it much, much easier for compliance.
Hi, everyone. Looks like Ric's having some audio trouble here. I don't know how he's going to finish his thought. So let's touch on some topics that a lot of people are talking about, retirement plans, 401ks. So what's your feelings in terms of our 401k is going to allow for Bitcoin ETFs to be part of client portfolios?
That's a good question, Don. It's not something that I've run across specifically, but I think there are 401k providers that are starting to look at this more seriously, you know, because it's a different, you have another layer of perspective there through the Department of Labor, which they really have been pretty antagonistic towards digital assets and investing in general. So I haven't seen any that have come out and approved it, but maybe AJ is aware of some.
I mean, I hope I don't get my firm in trouble, but we can invest in Bitcoin in our 401k at BitGo. But to piggyback off of that a little bit, we do see a lot of our clients have assets in IRAs because of the tax advantage, because of the high appreciation of those, whether it's a Roth or a traditional, or like I know Matt also sort of nodding his head, like, you know, a bunch of our assets are in IRAs because, you know, they sort of see the value of, if this is going to be a multiple beta product that we think is going to be significantly higher in the future, outperforming the S&P 500 or some of those equity markets, you're going to want it in a tax efficient vehicle, and the IRA does that. So like I'd be all pro 401k, but also I, you know, along Matt, I don't really know.
Gotcha. So far we've talked a lot about Bitcoin, which is one altcoin that's out there. What about Ethereum? Do you guys see Ethereum overtaking Bitcoin in terms of usage as smart contracts advance?
I think they're two different use cases. So we have them, and we have two different portfolios in Bitcoin and Ethereum, both of them, and I think they have very different use cases. I think there's actual now legitimate other layer one competitors to Ethereum that are worth looking at. And so I still, and I'm not one of those, I tell people like I'm a recovering Bitcoin maximalist. I think there's value in Bitcoin. I think there's value in Ethereum. And I also think there's value in some of these other competing layer ones. So Don, I'm not going to give you a straight answer, but you know, will the flippening, will that ever happen? Which means will Ethereum's quote unquote market cap ever overtake Bitcoin's? Maybe. But I do think there's room for both, and I think there's actually room for even more.
And Don, I think this is why you hire someone like Matt to build these strategies, because like it takes a lot of work to figure out the different nuances between these different layer ones or different assets. So although there's no definitive answer, if you put in the time and the work, you can at least have a hypothesis in an overall portfolio. And, you know, like anything, you win some, you lose some. But a lot of times, you know, if you do the due diligence and you put in the work, you'll come out ahead.
And this goes back to Ric's earlier point, right? It's owning more than just one digital asset, right? You're not just going to own one stock. You're not just going to own one commodity, right? You're going to own, you need to be more diversified. And so having exposure to both, if one of them maybe, you know, not my thesis, but if one is the ultimate winner, you've got exposure to one of them.
Ric, you back?
I think I managed to be back. Don't you love we're talking about technology investing and my technology craps out on me? So Don, thank you for jumping in. Redundancy is always key when it comes to anything. And so I'm glad, Don, the president of DACFP, you were able to jump in so fast. So I appreciate that and everybody's tolerance for this. I'm not sure how much I was able to get across when my connection died on us, but the real issue I think for advisors is, despite the fact that you might want to engage with a client when your firm doesn't let you, if your firm doesn't let you, your firm doesn't let you. You've got to be safe first, compliant first. And if you cannot, then you cannot, no matter how much you might want to help the client, which means you need to do two other things. Number one, try to persuade your advisory firm, your compliance officer, your head of investment committee, your sales and marketing team. You need to persuade them. And the new Bitcoin ETFs make the bar lower than ever. It's been easier than ever for a CCO to say yes to this. I do a lot of consulting in this area, and I know that Matt, Arbor Digital, does a lot of crypto consulting. Spend a couple of minutes real fast and talk about the work you do with firms who think this is a lot more complicated and scary than in fact it really is. Talk about your consulting practice.
Yeah, that's what just popped into my mind when you were describing that. Yeah. we can help people craft an investment thesis and engage with an investment chair to help them understand and how to best incorporate digital assets into their overall firm practice. So it's part of our is an expanded consulting agreement. We'll come in and help people from an RIA perspective, and even from a platform perspective, help them think through how to best go to market for their own clients and to bring their product forward in a way. We've been in this industry, I've been in the digital asset industry almost 12 years, personally, professionally for about 6. And so we've learned an incredible amount when we can bring that to your firm to say, this is the best, this is what we've learned, this is the best way for you to approach the market with what you're trying to do.
Yeah, because let's face it, just as most advisors are relatively unfamiliar with crypto, so are most compliance officers. This is a brand new asset class. There is no institutional knowledge about this. So naturally, if you're a compliance officer and you don't know anything about crypto and an advisor says, can I sell it to a client? Your instinct is going to be no, because I don't know what I'm saying yes to. So we need to train the compliance teams and the risk management teams and the investment management committees as much as we need to train the advisors and the clients. So it's all about knowledge, education, training. That's what we accomplish in our CBDA course. It's a lot of the consulting work that Arbor Digital does. It's the foundational work that BitGo does. This is really an essential thing. So if you're dealing with a firm that isn't allowing you to offer crypto to clients, add a word to that. Yet. They're not letting you do it yet. And to help get to the point where it is now, not in the future, just engage them to have a conversation with Matt or with AJ or with me, and you'll be surprised. They'll be surprised at how easy it is to get to yes. That it's compliant, safe. You don't have to fear the SEC or FINRA. Working within the parameters that both of those regulators are providing, there is a path forward, and the new ETFs in particular make it easier than ever. Gentlemen, this has been really a pleasure to be with you. The information you provided is fabulous. I hope everybody has clicked on the links that we provided in the chat, because the documents that you have made available to everybody, the due diligence form and the custodian evaluation guide is really terrific. There's a lot of content we have shared with you. Be sure to click on those links so that you can gain access to this. Share it with your compliance team, share it with your sales and marketing team, your investment management team. A lot of the work on how to do due diligence in crypto has been done for you by these two organizations, and I hope you'll take full advantage of that. So gentlemen, thank you so much for joining us on this program today. I want to let you know that we have another webinar coming up on March 5th, just in a few weeks. What you need to know about the new spot Bitcoin ETFs with Matt Hogan of Bitwise. I particularly encourage you to visit with us in West Palm Beach, Florida in March 10th and 12th, where we are presenting our wealth management convergence, the investment strategies that advisors need today. This is not a crypto conference. It's on the broad-based topics that really matter today: generating income for clients, longevity, estate planning, 529, AI, as all the topics that are really impactful for your practice today. The QR code right there will send you right to all the info. We also have our crypto conference, Vision, which is the 6th annual. This is the longest running and largest crypto-only event exclusively for financial advisors. June 2 to 4 in Austin. It's a fabulous content, and I really look forward to seeing you there. If you're new to the spot Bitcoin ETFs, we have a brand new advisor toolkit, a cool little grid that'll compare all the ETFs for you, lots of content, videos, audios, white papers, infographic that you'll find really helpful. It's brand new, it's all free, and that QR code will take you right to it. We also have podcasts and webinars on all of these new spot Bitcoin ETFs. And importantly, I encourage you to get your CBDA designation and become certified in blockchain and digital assets. You'll learn up to 18 CE credits. You'll learn not just about the tech, but most importantly, all about the practice management with 5 different tracks for you as a financial advisor, for compliance and home office professionals, for crypto professionals, investors, and there's even an ex-US track because we've got folks from 37 countries who have gone through the program, thousands who have obtained their CBDA designation. Be sure to read my #1 Amazon bestseller, The Truth About Crypto. A lot of advisors give it to their clients. It's a great value add.
And listen to my daily podcast, which is available everywhere you get your podcasts. It's in the top 1% of all podcasts and covers the topics that matter most to advisors and clients today: longevity, retirement security, exponential technologies, health and wellness, and of course, crypto. With all that, thank you so much for joining me here today. Appreciate your being with us. We'll see you next time.